WTI oil just plunged 10%. But what's really driving this market shift? In today's volatile financial landscape, an unexpected market tremor has sent shockwaves through the global economy. Oil prices have plummeted by more than 10% in a single trading session, a collapse that caught even seasoned analysts off guard. The catalyst? A surprising announcement from President Donald Trump indicating a pause in military actions against Iranian infrastructure. As investors scrambled to reassess their positions, stock markets surged in response, while oil took a nosedive. Here's the part nobody's talking about. The implications are vast for portfolios everywhere. This is not just about numbers on a screen, it's about safeguarding your investments in turbulent times. Stay with us as we delve into whether this seismic shift spells opportunity or serves as a warning sign of further upheavals. Over recent months, geopolitical tensions between the United States and Iran have escalated, severely impacting global oil prices. Earlier this year, a combination of sanctions and military threats led to a 50% surge in oil prices as traders braced for potential supply disruptions. However, today marked a dramatic reversal with Trump's unexpected announcement of a pause in aggressive tactics against Iran. This détente has temporarily eased market fears, but the quick shift in oil pricing is unprecedented. The United States Oil Fund, ticker symbol USO, reflecting these developments, dropped nearly 10% in a single day, a significant market movement. Here's the part nobody's talking about. Conversely, technology stocks such as Nvidia and other sectors experienced an uptick as the focus shifted away from energy commodities. The essential question remains, can we trust this newfound market calm, or is it merely the calm before the storm? And here's how this energy move ripples into the broader market. The data. At yesterday's close, the United States Oil Fund USO fell to $110.56, a stark contrast to Brent crude's earlier highs exceeding $120 per barrel. This represents not just a routine market fluctuation, but a dramatic revaluation impacted by geopolitical developments. Traders were swift to react following Trump's diplomatic overture to Iran, leading oil futures to sharply drop. The market's rapid response reflects underlying uncertainty. Here's the part nobody's talking about. Expert opinions are divided. Some view this as a rare buying opportunity, while others advise caution, predicting potential further drops. These figures paint a vivid picture of market sentiment. Volatility reigns, and the stakes are high. Iran's centrality to global oil supplies cannot be overstated, with the Strait of Hormuz accounting for a third of global maritime oil transport. The geopolitical chessboard in this region has kept traders on edge, as potential disruptions could send prices soaring. Trump's latest diplomatic maneuver suggests a possible easing of tensions, restoring hopes for stable supplies. However, beneath the surface, market dynamics show shifting alliances among investors. Smaller, previously vulnerable companies are beginning to rebound, led by tech powerhouses like Nvidia that have gained significantly from recent market shifts. Here's the part nobody's talking about, yet the potential for volatility remains. A single incident in the Strait of Hormuz could swiftly reverse current price trends. As we peel back the layers, it becomes clear that tech's resurgence may obscure deeper financial vulnerabilities tied to global energy reliance. In the backdrop of this complex tableau lies an unsettling consideration. What if the diplomatic pause is short-lived and prices return to the $100 per barrel mark overnight? In comparing recent market performances, technology sectors, led predominantly by Nvidia, show a remarkable 22% gain amidst widespread uncertainty. In contrast, energy stocks are experiencing severe losses, grappling with recent oil price declines. This divergence questions whether we are witnessing a corrective temporary market realignment or the initiation of a more sustained sectorial trend shift. The indices like Russell are caught in this flux, reflecting mixed investor sentiments. This data compels investors to ponder, if geopolitical tensions resurface, leading to potential oil price spikes, how resilient will these sectors prove? Here's the part nobody's talking about. The data-driven narrative unfolding before us suggests that the number to watch is the oil price rebound as geopolitical narratives evolve. The risks associated with the current oil market dynamics are immediate and pervasive. Potential renewed hostilities in the Strait of Hormuz could propel oil prices dramatically upward, impacting global supply chains and cost structures. This scenario poses particular challenges for small-cap stocks, highly susceptible to oil-induced volatility, as evidenced by recent market behaviors. Meanwhile, technology stocks, riding high today, could encounter significant headwinds if broader economic conditions take a turn for the worse due to rising energy costs. Long-term investors face a complex landscape. Vigilance is paramount, as the next significant price movement could arrive with little warning. Here's the part nobody's talking about. In navigating these unpredictable markets, understanding the intricate web of risk factors is crucial. What happens next depends on the interplay of these evolving geopolitical and market forces. Looking ahead, the market's response to President Trump's announcement signals temporary relief. Yet caution remains a prudent strategy. As geopolitical uncertainties loom, the market's resilience will be tested. Investors may consider realigning their portfolios, emphasizing sectors that demonstrate resilience amid volatility. The next few weeks provide critical observation points. How will international relations evolve, and what implications will they hold for global markets? Strategic decisions made now could define profit trajectories as this complex situation unfolds. Here's the part nobody's talking about. The critical balance lies between seizing beneficial opportunities and mitigating emerging risks. Watch closely as this dynamic story continues to develop. In summary, today's oil market upheaval presents both potential gains and inherent risks. My recommendation is one of cautious optimism. While the market signals opportunity, the underlying risks cannot be ignored. The unexpected 10% drop in oil prices serves as a reminder of the inherent volatility of global markets. As investors, staying informed and adaptable is key. While many were caught off guard, the astute observer recognizes volatility. Here's the part nobody's talking about. As a dual-edged sword, while it can yield profit, it also demands preparedness for potential downturns. Equip yourself with insight and foresight, and you'll stay ahead in this ever-evolving financial landscape. Missed the latest market moves? Subscribe to Profit and Peril and stay on top of crucial financial shifts. We're tracking tech rallies amid low oil prices and much more. Don't get left behind. Let's discuss. Are you buying, holding, or selling? Join now and never miss another market opportunity.